Yes, today we are going to look at Introduction to Accounting. Yeah, this module is called Fundamentals of Accounting. So under it, we are going to look at Introduction to Accounting. Basically, today we are going to introduce what is accounting. So accounting, basically, it means the systematic process of recording, summarizing, analyzing, and reporting financial transactions and events in an organization. That's basically the meaning of accounting. So under accounting, basically, we look at bookkeeping. What is bookkeeping? Is the foundational aspect of accounting that involve the systematic recording and organization of financial transactions within an organization. That is the meaning of bookkeeping. So we look at the key aspects of accounting. What are those key aspects of accounting? Under it, we have recording. Under recording, it involves documenting financial transactions as they occur. You document the financial transaction as they are. You don't need to change anything. So we have summarizing. Under summarizing, it involves organizing and categorizing financial data into a meaningful report. You organize and you categorize where the financial data, all the data where it falls, you organize and you categorize them into a meaningful report. So we have analyzing. Under analyzing, it involves evaluating financial information to make informed decisions. So we have reporting. It involves communicating financial results to stakeholders such as investors, creditors, and management. So under here, you communicate financial results to the stakeholders. You present the financial results to the stakeholders. For example, we have investors, we have creditors, and we have the management. So let's look at the role of accounting in a business. We have financial management. Accounting provides framework for effectively managing finances, including tracking incomes, expenses, and investing. So if you have accounting in your business, it will provide the framework for managing finances. It makes it easier to manage your finances through accounting. This includes tracking income. You can be able to track your incomes. You can be able to track your expenses and your investments. So, two, we have data for decision making. It helps in data for decision making. It's generally crucial financial data that aids manager and stakeholders in making informed decisions about investments, expansion, cost control, and more. So for investments, these ones it helps the stakeholder. And expansions made the managers can be able either to know where they can expand or to know the cost. How can they control their cost? Through accounting, they can be able to come up with that decision. So when we have transparency and accountability. Through accurate recording and reporting, accounting ensures transparency in financial transactions, promoting trust among stakeholders. It also helps in holding individuals accountable for financial responsibilities. That is transparency and accountability. So we look at accounting. We look at accounting principles and concepts. One, we have principle of entity. What does the principle of entity say? It says each business is separate entity from its own. Each business is a separate entity from its owners. That is the principle of entity. So we have principle of historical cost. Financial transactions are recorded at their historical cost. Then we look at the principle of consistency. The same accounting methods used should be used from period to period. So you should not change the accounting method. You should use the same period to period. So we look at principle of materiality. Only information that is significant to the users of financial statement should be included. You should not include irrelevant information. It should be only the information that is significant to the users of financial statement that should be included in your report. So we have the principle of full disclosure. All relevant information that could affect the users of financial statement should be disclosed. You should disclose all that information, all the data that's supposed to be used. So we look at the types of business entities. We have sole proprietorship, a business owned by one person. That is sole proprietorship. It is one person that came up with an idea and starts and open up a business that is owned by him alone. He doesn't. There is no one that is in partnership with. So we have a partnership, a business owned by two or more people. Two people came up together with an idea, so they open up a business. It might be two people or more than two people. They may be 3, 4, 5, any mention. So we have corporation, a business that is legally separate from its owners. It is a single entity. It can be in search of a law. Yes, corporation. So we look at the users of accounting. Usually we have two types. We have two users of accounting. We have internal users of accounting and we have external users of accounting. Under internal users of accounting, we have the management, we have the employees, and we have the shareholders. Those are under the users of accounting. So when we talk of internal users of accounting, what comes into your mind? These are people within business organization who use financial information. These are the people that work within the financial, that works within the business organization, who use the financial information. So we have the managers, we have the employees, and we have the shareholders. So let's look at the external users of accounting. Under them, we have creditors, investors, tax authority, consumers, researchers, competitors, government, we have auditors. When we talk of external users, these are people outside the business entity who use accounting information. They are outside your business entity, but they use the financial information of your business. For example, we have the creditors. The creditors, these are the people that demand the business. We have the investors, people that have shares in your business. We have tax collectors, people that come, tax authority. These are people who come and collect tax. We have consumers. We have researchers. We have researchers, we have competitors, people that compete with your business. They need to use your financial information. We have the government. and we have the auditors, people who come and audit your business. So let's look at the accounting equation. We have accounting equation. The accounting equation is the fundamental concept in accounting that states that it is fundamental concept in accounting that states that assets is equals to liabilities plus equity. So what are the assets? Assets are resources owned. These are resources owned by the business. These are resources that are owned by the business. Or these are resources that can be converted into cash. They can be easily converted into cash. Those are assets. So under assets, we have two types of assets. We have tangible assets and we have intangible assets. So under tangible assets, we have two examples of tangible assets. One, we have current assets and we have fixed assets. So under current assets, we also have examples that are under current assets. So there's examples, we have cash, that's the money, cash. We have cash equivalents. We have account receivable. We have stock, inventories. Then we have our short-term investments. Those are all examples of current assets. So let's look at the examples of fixed assets. We have buildings, we have machineries, we have computer equipment, we have tools, we have furniture, we have land, and we have motor van. Those are all examples of fixed assets. So we look at what are the examples of intangible assets. Under it, we have goodwill, we have patent, we have copyrights, we have trademark, brand recognition, we have business methodology. We have business methodology. So let's look at what are liabilities? Liabilities are the debts owned by a business. Those are liabilities. Those are it is an obligation of a business. So under it, we will have two types of liabilities. We have current liabilities, we have non-current liabilities. So under current liabilities, we have accounts payable, those are the creditors. We have notes payable, bank accounts overdraft. What are bank accounts overdraft? It's a bank withdrawals. It's when the bank withdrawals is greater than the receipts. That is bank overdraft. So we have accrued expenses, the expenses that have been occurred or recognized but not yet be paid to the supplier. So we have equity. Equity is the owner's investment in the business. What you put in your business, that is the equity. It's what you invest, what you get in. Like when you're operating in a business, the money that you get, that is your equity. So we look at an example of accounting equation. For example, let's say a business has assets of $100, liabilities of 50, and equity of 50 USD. This can be expressed in accounting equations as follows. You say assets is equals to liabilities plus equity. So our asset, it has 100 USD. So we have a liability, its amount is 50 USD. Then we have equity, which is 50 USD. So when you add liability plus equity, you should be able to get assets. That takes us back to our equation, which says assets is equals to liabilities plus equity. So let's look at other accounting concepts. We have revenue. What are revenue? The income that business earns from its operation. The income that you get in your operation, in your daily, what you get. That is your revenue. So we have expenses. Expenses. These are the costs that the business incur in order to generate revenue. What you put in order to generate that revenue, those are expenses. For instance, we have electricity bill, we have water bill, you may have transport bill. For example, when your business is dealing in transporting the money that you incur in bringing the goods, and so many on. So we have gains, increase in the value of business assets that are not the results of its operation. What you gain, but it is not part of your business assets. So we have losses, decrease in the value of business assets that are not the results of its operation. What, like the discounts that you gain. We have cash flows, the movement of money into and out of the business, how your money moves in and out of your business, that is cash flow. So we have a profit, the excess of revenue over expenses. So after subtracting your revenue, remember revenue, it's the money that you get, it's the income that the business earns from its operations. Then we have also expenses. So when you get your revenue, you subtract expenses from the revenue, the money that you get, that is your profit. So we look at the importance of accurate accounting. Accurate accounting is essential for business to make informed decisions, attract investors and creditors, and comply with government regulations. So we have the business, it helps in making decisions. It helps in making decisions. It attracts investors. When investors see that when your accounting is accurate, it will attract investors. So we have creditors. Creditors, like when you want to get a loan, they will have to first ask. If you're a business, you want to get a loan, you have to first present your financial statement and they see. So if you have an accurate accounting, you can be able to get a loan easily. So, and comply with government regulations, you'll be able to pay taxes when you have accurate accounting. And you'll be able to monitor each and everything. Then we have So inaccurate. How does inaccurate accounting affect your business? One, we have inaccurate accounting can lead to financial losses. You can get losses when you have inaccurate accounting, legal problems, and damage to business reputation. It can damage your reputation, it can damage your name. So let's look at the accounting cycle. The accounting cycle, it's the process of recording, summarizing, and analyzing and reporting financial transactions. So this accounting cycle, it looks at how accounting moves. So this one takes us back to the definition of accounting. It's a process of recording, summarizing, and reporting financial transactions. So after it, we have steps that we look at. Step 1, identify and record transactions. You have to identify which transactions that you have, then you record them. You have to, as for example, you have to identify the assets that you're having, the expenses, all that, then you record them down. Then you post transactions to the ledgers. You put them in the general ledgers. We shall look at that. Then we have a preparing trial balance. You prepare a trial balance. Then we preparing adjusting entries. You prepare adjusting entries. Then we have a preparing financial statement. Preparing financial statement. So what is a general ledger? It's bookkeeping ledger. It is the bookkeeping ledger in which accounting data are posted from journals and are graded. For example, we have accounts payable, accounts receivable, cash management, fixed assets, purchasing, and projects. Those are the examples. So what preparing? We prepare a trial balance. What is trial balance? A trial balance, it is done to check that the debit and credit column totals of the general ledger account match each other. So we have two sides in a trial balance. We have debit sides and we have credit side. So when you're preparing a trial balance, you have to make sure that the credit side is equal to the debit side. They have to balance up at the end of your calculation. It has to balance up. That is trial balance. You have to put all the entries. So thank you very much for today's lecture. We shall meet again. Let's meet on Monday for another session. Thank you.